Good morning, ladies and gentlemen, and welcome to this first seminar session of the second day of Mortgage Business Expo. I'm Robert Sinclair, Chief Executive of the Association of Mortgage Intermediaries, and it's my pleasure to host proceedings here for the day. Before I pass over to Mark Baker, who's going to take us through the economy, housing and mortgage market, I just want to touch on a couple of things about the market and the Association of Mortgage Intermediaries. AME recently took itself out of its parent trade body, AIFA, the Association of Independent Financial Advisors. The reason the board of AME decided to do that was it wanted to give AME more independence and strength to focus on what was important for AME. And AME is here to look after, promote and protect the interests of mortgage brokers in the UK. That's my sole job, to go and talk to politicians, regulators and anybody else who matters, both in Brussels and in the UK, to try to make sure that your jobs are not made more difficult by people who want to put barriers in your way. My job is also to try to talk to lenders to make sure that the same thing happens, that they believe totally that brokers are a great way to do business in the UK. And the last part is to try to find a way to persuade consumers more and more to understand that actually if they go to a broker rather than direct to a lender, they're more liable to get a great deal. Now that is the reason that a number of people pay me to do this job on your behalf. So of the 15 largest groups, whether that's directly authorised firms or networks, of the largest 15, 13 are members of AME and 2 are not, and we're in discussion with them at the moment about them becoming members. But anybody who is not a member of AME should probably become a member, and they can do that by going to our website and finding how to do that, or they can come and talk to me or Alex Ravel, who's with me, about that at any point. It's really important we have more and more people in membership because that funds our ability to do what we need to do to promote your interests with the people who matter. And the other part of this is that there are a number of things still to be done, even linked to the mortgage market review, in terms of making sure that this is implemented in an appropriate way. And one of the reasons why we've asked the FSA to come and talk about supervision this afternoon, as opposed to normally what we just talk about, is the policy side. Because we recognise that we spend an awful lot of time talking about the policy side and get the documents to point of rules, but then we stop and we don't hold the regulator account on how they supervise against those rules. And therefore our big challenge over the next couple of years is making sure that the regulator does that in an appropriate way. The last thing I wanted to touch on was just this area of individual registration, which is something that most people think we should have, in that we go back to the Mortgage Code Compliance Board days, we had it, and we need it again now. And I will be working together with other parts of the industry to ensure that if there is a way of doing this, we do it sooner rather than later and waiting for the FSA or the FC as its successor to deliver this, because it looks like it will be a very long time until they can do that. The challenge for us, I think, though, is avoiding building something which means that it treats people unfairly. So if it's going to be a register of people, it has to be everybody, not just brokers, but also people who sell directly in lenders, and we control the whole of the marketplace and supervise it in an appropriate way. And we find a fair way of taking people off that register if that's appropriate at any point in time. So there needs to be a proper way of controlling that. That's enough from me. On your desks, on your chairs, there is a copy of the quarterly economic bulletin that we produce. It's one of the, I suppose, most simple and straightforward analysis I know of the UK economy and its impact on the markets that we all operate in. We produce this through Mark Baker and Teamspirit every 3 months. And I believe it's gone a long way over its last 6 years to help people understand an awful lot more about the interrelationship between what's happening in the broader economy and then into our industry. So I'm delighted to welcome to the stage the man who works with me producing this every 3 months, Mark Baker. Mark.
Good morning. Thank you very much for having me here today. As Robert said, I work for an agency called Teamspirit, which is a marketing and public relations agency, but the reason I work there is because we pride ourselves on a really deep understanding of financial markets, the economy, and how we can use that knowledge and research in particular to help our clients. And that's one of the reasons why I've been working with Robert for so many years now on this report. And one of my other roles is also as an economic consultant to the City UK, which is the umbrella body that represents British financial services both here and in the UK, both here in the UK and abroad, to help to try and raise the profile and the success of all of our industries around the world. So my background is having spent 9 years as an equity research analyst in the city. I gave all that up to go and do public relations and research work to help promote our clients. And so that's really why I have some view, I think, to share on the economy and how it is affecting those people in this room and the industry in which we're all working. Now, what I want to do today is start by looking at the current state of the UK economy and how expectations for its development and its current performance have developed over the last year or so. Discuss the reasons why it is currently the way it is, and then finish with a look at how that's impacting on both the housing market and the mortgage market, which are obviously completely interrelated. I'm going to start with one of my favourite charts, which was a chart produced by the Office of Budget Responsibility in March this year, only in March this year. And what it tells you is where the fan begins is where the economy was in March. And all of those lines that spray off from that point are the sort of various probable paths the economy might take over the coming sort of 4 years from that point. Now, what you can see is that we're already about 8 months on, and we are in a sort of area in which the Office of Budget Responsibility thought we had about a 1 in 5 chance of being in terms of how weak the economy is. If you look at the second to bottom line, it's sort of second palest grey. That's roughly the end of 2012. That's the line that says the economy will be 0 to slightly down this year. And even as recently as March, they only thought that had a 20% possibility of coming true, and there we are already. So things have obviously not gone according to plan this year. And there are a number of reasons for that. And some of those reasons are domestic, and we'll talk about those, but also, very crucially, what's going on in the international economy. And that's looking pretty bad. It's actually, two of the words you might see in the media today are polaxed, people referring to the international economy. China has been one of the big drivers of growth internationally, 9 to 10% economic growth over the last few years, obviously very much in the news at the moment with the new leader and what they're going to do. Actually, China may only be growing 6% next year, and it could be worse than that because there is some question mark over the reliability of some of the statistics coming out of China. Now, that is the second largest economy in the world. That affects everybody. Similarly, the US. Now, they have got a lot of debt that they have to pay back and a very large budget deficit, and it's not yet clear whether Congress and the Senate are going to successfully roll over the financing arrangements that the US has. Now, that alone could knock 3 percentage points, if it weren't rolled over, 3 percentage points off US GDP, which would be enough to take about 1/3 to 1/2 percentage point off global GDP if it happens. So these things really matter, and they matter to us because they are our market. That's where we potentially can export to. They're what drive confidence, both in terms of British businesses doing business abroad, but also in terms of consumer confidence here in the UK. Now, the IMF has cut the expectations for global growth next year from 3.9% to 3.6%. Obviously a lot better than we're doing in the UK, but bear in mind, many of those are those big emerging economies that have been growing very, very fast recently. And they say that the risks of recession in the advanced economies are alarmingly high. That's the IMF's words, not mine. The Eurozone, in Craig Greville-Horwood's words, is a complete disaster. Austerity is driving a falling demand, rising unemployment. The big issue inside the Eurozone is that major difference between the deficit countries and the surplus countries, and they're not meeting in the middle. Germany thinks it has a right to continue exporting to countries and lending them money to buy all its exports. Those countries can't borrow anymore, so they're not going to be able to buy German exports. Now, both of those problems meet in the middle in a big car crash, and that's what's happening right now in Europe. So as long as austerity keeps happening in southern Europe, it's actually going to be more and more difficult for even the surplus countries to continue to perform well inside the Eurozone. And remember, the Eurozone is about half, or the EU is about half of all of UK exports. So what happens there directly impacts here in the UK. Overseas demand is very, very important for driving our own economy. But obviously, there are domestic factors too. The The actual likely outturn for growth in the UK this year is going to be about 0% to minus 0.2%. I'm a little bit more optimistic than consensus, but that doesn't mean very much, to be quite honest. And I'll show you what's happened, and we'll talk a little bit more about those domestic factors over the next few slides. Now, this is the evolution of forecasts for 2012. If you see back in March 18 months ago, everyone thought that the economy would grow about 2% this year. And steadily, they've been slashing their expectations quarter on quarter on quarter, month on month on month. Particularly bad at the end of last year. That little brief blip you can see in March was just before those awful first quarter GDP numbers came out, when everyone realized that we were heading directly back into recession again, and all of those forecasts were then cut, so that you can see from the summer onwards, everyone, this is the consensus of independent economists in the UK, everyone was expecting the economy to be down for the full year overall. This is 2013. Similarly, growing pessimism, although not quite the kind of precipitous declines that we've seen for this year, but mainly because the numbers are pretty weak anyway. When people talk about double dip recession or triple dip recession, which is what Mervyn King was talking about yesterday, again, it sort of doesn't matter whether we're plus 0.1% or minus 0.1%. It's so weak either way that it's effectively a flat to nothing economy. It doesn't really mean we're shrinking dramatically, but there's no dynamism there either. So I wouldn't get too hysterical about triple dips and double dips and the rest of it, but what you should be depressed about is the fact that nothing much is happening at all. Remember that typically in the past we were expecting the economy to grow about 0.6 to 0.7% every quarter. Now we're bumbling around 0 to minus 0.1 to plus 0.1. So they're all pretty feeble. Now, the Governor of the Bank of England yesterday said that his forecast for the UK economy for next year was going to be cut from 1.8% to 1.1%. Thank you very much, Mervyn King. Everyone was way ahead of you. For months, the consensus for the independents has been about 1% next year. And the Bank of England has been noteworthy in being behind everybody in forecasting both inflation and the economy. So it pretty much whenever you see him say something, you know that that's the sort of last bull standing. And I was reading an interesting article in the Telegraph this morning that was talking about what you should do in financial markets when everyone's been negative, but there are still a few people out there who are clinging on to a more positive view of what could happen. Finally, when they capitulate, that's the time to buy back in. Mervyn King's always the last one. So if that's true, then maybe there is some cause for optimism. But I have to say, I don't really see where the drivers for growth are over the next couple of years. If we look at what's happening in government spending, the cuts that we're seeing coming through are really only now beginning to come through, and I'll talk about those in a second. But we should expect them to be permanent. This is not a temporary period, and then we'll get back to sort of happy days of government spending again. This sort of austerity, if we like to call it austerity, is going to be pretty much forever. We are not going to get back to the levels of sort of government largesse that we have had in the past. Rebalancing the UK economy is also necessary. We need to have less of a reliance on imports. We need to have less of a reliance on consumption, a greater emphasis on investment to raise our productive potential in the future, and I'll talk about both consumption and investment in a minute and why that matters. And I think what you'll see next month is a kind of reassessment ahead of the autumn statement by the Office of Budget Responsibility, looking at what is likely to happen to government spending and borrowing over the next few years, and I think we'll be seeing some significant downgrades for expectations for bringing the UK's massive debt mountain and big deficit under control. And unfortunately, that means it's likely to mean slower growth for some time to come as well. We are going to miss the deficit targets that George Osborne set for us. We do not expect the share of debt as a percentage of GDP to be stabilised and falling by the end of this Parliament, which was one of the things they absolutely wanted to demonstrate. It isn't all bad. That big spike at the end was third quarter this summer, which showed a nice big uptick in growth. And I think that's why this year will turn out to be a little bit less bad than everyone thinks. But as I said, it's not very significant. Most of that was driven by services. And people often say that we should be having a lot more manufacturing in the UK. I don't think that's necessarily important if it's the right kind of services, and in particular the kind of services we can sell to customers abroad, because getting that net trade up is going to be an important part of rebalancing the UK economy from a sort of excessive consumption-led level of demand. So services are fine if they're the right kind of services. And manufacturing is nice if you've got sort of people who can buy your goods. But I think you'll see in the fourth quarter that the economy will have been flat and possibly even down again. But as I say, don't get too depressed by that. We're essentially bumping along at a sort of flat kind of level. Now, this chart is one of the most important charts to look at in terms of understanding what people think about the prospects for the economy. This tells you the price at which the government can borrow money over 10 years. 10 years is the kind of standard level that's used to compare different economies. Currently in the UK, we can borrow at 1.72%, which is lovely and low, well below inflation. So the money's free right now if you're borrowing for that sort of level. And what it tells you is that people don't really expect inflation to be at this kind of level, which is 2.7% right now, for a very long time. What that means is that people expect the economy to be weak. Now, there are three interpretations of very low bond yields like this. So you can see the big decline in the cost of borrowing to the government. The government will tell you that it is a demonstration of its credibility in bringing down the debt and the deficit. And yes, the government has actually done quite well in sticking broadly to its plans in bringing those numbers down. It's still not great. We still have one of the largest deficits in the EU. We're not much better off than some of those countries really struggling in southern Europe. But nevertheless, the government has demonstrated that it has a clear plan, and even if it's getting blown off course by some of the events that are happening, the events elsewhere in the world are often a lot worse. So actually the government has got an argument to say, yeah, we have a reasonably credible record. The second interpretation, which is the one that the Labour Party will give you, is that the economy is so weak that there is no chance of inflation happening in the long term, that this current bout of inflation will soon die out and the economy will be flat on its back indefinitely, and therefore there is no reason why interest rates should be high. And the third interpretation is that the effect of quantitative easing, which is the Bank of England's policy to try and boost the economy by pumping lots of money into it, printing lots of money in fact, effectively is financing the government. So there is very little private sector demand for government bonds. So when government borrows money, it issues bonds that are borrowed by banks and by consumers and by pension funds, who essentially lend that money to the government. Now, over the summer, the government issued £45 billion of bonds. The Bank of England bought 38 billion of them. So almost all of the demand that the government is seeing for its borrowing has been mopped up by the Bank of England. It's simply transferring from one part of the state to another part of the state. So private sector demand for those bonds is rather low. Now, given that there is very strong demand from the state, if you like, that has pushed down those borrowing costs. And that is an important part of that picture as well. So which interpretation do you like? I think it's probably a combination of all three. I'm sorry to say that's a bit of a cop-out. But it's definitely true that quantitative easing has pushed down borrowing costs. It's definitely true the economy is very weak. But also the government has got a legitimate call to say, we've got a pretty credible plan, and most people around the world think we're doing better than a lot of other governments are. I think at this point, it's worth thinking about where those drivers of growth can come from. And let's remember what an economy is made up of. Economics can be very, very complicated, but at its most basic, an economy is made up of government spending, consumer spending, investment, and trade. And trade is we talk about trade, we talk about net trade. So that's the amount at which your imports exceed your exports or vice versa. If your imports exceed your exports, then that takes off a level of your economy. That deducts from your economy. If your exports exceed your imports, that adds to your economy. So let's have a quick look through all of those. Government spending over the next, till 2016 is going to see a cut in current spending of about 3% in real terms. Government investment, much worse, 30% down in real terms over the next sort of 4 or 5 years. And actually investment, that's the kind of spending that helps the economy grow in the long term. Current spending is benefits, it's salaries of government employees and so on. Investment spending is building roads, bridges, infrastructure. And that's the kind of spending that allows businesses to expand more efficiently, to keep their costs down, to get their goods and their people around the country quickly, and to work more efficiently in the future. That is being cut. That's a very bad thing. But it's very easy for governments to cut capital spending, much more difficult and politically difficult for them to cut current spending. Businesses also aren't investing. Business investment is still 10% lower in real terms than it was 5 years ago. And that's because businesses don't see any demand coming through. There's not demand for their products and services, so they don't need to expand their capacities. They don't build new factories. They don't take on new office space, buy new computers, and the rest of it. That's why business investment is still pretty flat. Trade. Well, trade actually, over the last few years, has been a little bit better. You've all noticed how low the pound has been compared to where it was in the sort of 2006-07 period. That has helped boost UK net trade. That's added to growth about 2.5% over the last 5 years. The Office of Budget Responsibility reckons it's going to add about 0.3% to GDP growth per year over the next 3 or 4 years. I think that's probably a little bit optimistic. Looking at what's happening in the world economy right now, it's hard to see foreign demand being that strong for UK goods and services. And in any case, trade is a pretty small proportion of the UK economy. Consumption is the biggest section. 65% of our economy, 65% is consumer spending. Government spending is about a fifth, and then the rest is investment and trade. Now, this chart here tells you a very big and very important story about consumer spending. The bottom line is earnings, the top line is inflation. Earnings are keeping consistently below prices. So if earnings grow slower than prices, people can afford to buy less stuff. And that means that consumer spending is weak and is likely to stay weak for as long as earnings remain subdued. In addition to that, so not only are consumers suffering on the income side, that goods are getting more expensive relative to their wages, but consumers are also still highly indebted. They have large mortgages and still relatively large personal loans. And although that process is unwinding, as long as people do remain indebted and they feel not very confident about the economic future, they're not likely to go out and spend more money. So consumption is likely to remain pretty weak. Now, inflation's just shot up again yesterday. It was sort of artificially down probably in the last month. It shot up to 2.7% yesterday. I wouldn't get too worried about that. Some of it is student fees. In fact, I think the largest reason for the increase was the rise in student fees, which doesn't affect most of the population. So it's likely to unwind quite quickly, and it's not likely to affect most people's pockets. But the general point that we have with inflation is it's unlikely for another year, and this is now the Bank of England. Remember, we have to be a little bit cautious about how optimistic the Bank of England can be. The Bank of England says it's going to be the end of next year before inflation comes back down to the 2% level, which means that we're likely to see that situation persist for a little while longer, which obviously is bad news for economic growth overall. So all of those four main drivers are not looking terribly good right now. Trade is probably the most positive of all of them, but of course is a bit at the mercy of the global economy. Now, this is an interesting chart. Unemployment, you've all seen the news. Unemployment consistently does better than most people thought. And it's a bit of a thorn in the opposition side every time they see good numbers coming out on employment. And no one, admittedly, has really successfully explained why in such a weak economy, unemployment continues to fall. And it fell again this week to 7.8% from 7.9%. The claimant count's up a little bit, but overall, this is good news for the Treasury because it means that tax revenues stay relatively high and it has fewer people to pay benefits to, although, as I say, the claimant count was a little bit higher. Why is this happening? Well, two reasons probably help explain it. First of all, that previous chart, low wage growth, means it's relatively cheap to employ staff right now. And of course, businesses are looking at employing part-time staff, and there's a lot more self-employment going on as well for people who can't find jobs, are just trying it on their own. But probably more importantly, it tells us about productivity. Now, productivity is a measure of our competitiveness as an economy. And the UK doesn't generally do very well on measures of productivity. And most likely, the fact that we're seeing employment levels continue to rise while the economy remains relatively flat, remains that output per worker in the UK is falling, which means we're lagging further behind other countries. It could be, one explanation for this could be that companies, as we know, they're not investing. As I said, 10% lower investment from businesses in real terms than we were 5 years ago. What they could be doing is substituting additional people in their firms instead of investing in extra capital. So instead of investing in extra machines and equipment, they could just be putting more people on the job to get the same work done. And that could partly explain both the good employment levels and the low productivity levels and the low wage increases. But we're probably not going to know that for a year or for a few years until all the revisions come through and people can analyse properly what's been going on. But really for the long-term health of the economy, we need to see that productivity number start to go up. And this is at least probably an admission by firms that they don't want to lose their skilled labour and they're going to hang on to it as long as they can. And that is a good thing. So, given that's our background, doesn't look terribly exciting for the UK economy for the next 2 to 3 years. I would expect us to be stuck in a very low growth scenario, probably not exceeding 1 or 2% over the next 3 years. What does that mean then for the housing and the mortgage markets? Here's the gross lending figures from the Bank of England. Now, lending is, like everything else in the economy, a function of supply and demand. So you both have to have people who are willing to lend money and people who want to borrow it to make sure that you actually get growth in gross lending. And this is gross lending to the mortgage market, of course. Now, in real terms, what are we now? About £11,000. In real terms, £11 million, billion pounds, a month. £11 billion a month is roughly where we were in 1999 in terms of mortgage lending. We've gone back 14 years relative to inflation in terms of the amount of money turning over in the mortgage market. And remember, I think I've got some here, the rolling number that we're on at the moment. Well, I haven't written it down, but anyway. Yes, rolling, of course, we're about 140 billion for this year. So compare that to the peak of the market in 2006-07, where it was a rolling maximum of 380 billion pounds of gross lending turning over in the mortgage market. This year will be at about 140 billion. All of that gross lending is if you like, energy, it's fuel flowing through the market. Obviously, for remortgage business, that's fees, that's jobs, that's all the rest of it going through lenders and the broking market. And for the purchase market, it clearly is new money flowing into the housing market. Lending is very fundamentally what drives the housing market. So for as long as these challenges face the lending market, I would not expect much to happen in the housing market. Let's look at the supply side quickly of lending. The banking sector is not likely to have money to lend for quite a long time. It doesn't matter how much the government stamps its feet and tells banks to lend. as long as the government is busily tying those feet together so that the banks can't jump up and down either, then those banks are effectively hobbled and they can't lend more money. The government is telling the banks they must increase their capital. Now, increasing capital means you cannot lend, because capital is the basis against which your lending is measured. If you have to have a smaller amount of lending relative to your capital, then either you can cut your lending or you can increase your capital. If you increase your capital, that also means there's less available money for lending. So that it just, either way you look at it, when banks have to raise their capital base relative to their lending, that is bad news for the mortgage market. The government's actually putting greater pressure on our lenders than some governments are elsewhere in the world. There's this phrase called super equivalence, which refers to the way in which the government here and the regulatory authorities here are putting greater pressure on our lenders to meet higher standards of prudent financial management and balance sheet management than elsewhere in the world. So the Basel III agreements are what govern the international rules on how much capital financial organisations have to hold. The UK organisations are saying that our banks are going to have to hold more than that. One of the reasons they say that is because we have bigger banks than everyone else, and our banks are more systemically important to the world economy than others, and therefore we don't want to have to bail them out if things go wrong, so they have to hold more capital. The trouble is that it has a very negative and instantly negative effect on the UK economy, both in terms of how much they can lend to the mortgage market, but also in terms of how those banks are able to compete abroad for other business. If they have to hold more capital than a bank in Germany or a bank in China, when they're bidding to finance a big infrastructure project somewhere, that means that UK banks are already going to be in a worse position than other banks, because they are structurally going to have a more difficult time to make profits if they have to hold more capital. So it's difficult for the banking sector to actually find the money to do additional lending as long as those regulatory pressures remain. On the demand side, well, we've talked about that already. We've looked at how little money consumers have. We've looked at how slowly their wages are growing. We looked at how high prices are rising. And we've talked about the fact that consumers also still have a lot of borrowing, both in mortgage and in unsecured lending terms. As long as that happens, and as long as they're not confident about the future, they're unlikely to also have much demand to borrow. So I think both of those factors mean that we're going to likely see this gross lending track along around about £140 billion a year, which is where it's been now for about, 4 years, Robert? Next year it might be a little bit higher, maybe towards 150, but that's really arguing a very small margin compared to the sorts of levels of activity we might like to see. So it may be improving a little bit, but not at the sort of speed we might want to see it happen. So clearly there's going to be an impact on house prices and on transaction volumes, and here you can see the two. Now, this big dip over 2008-9 is when the really bad bit of the recession happened following the financial crisis, and you can see that sales volumes collapsed and prices fell very quickly as well. And you can see that those two lines are quite closely related. Now, housing transactions now are effectively flat. We'll probably see around 670,000 houses and flats bought and sold this year. That compares to a peak of about 1.3 million on a sort of rolling basis back in, I think the peak was 2006. Prices continued rising after the peak in transactions a little bit, but we're running less than half where we were at the peak. Now, I don't think anyone who tells you that this is a depressed level and will bounce back one day to that 1.3 million transaction level, I think they're probably wrong. I don't think we'll ever likely get back to that kind of level of activity in the housing market. We'll probably do better than 670,000, but this is probably close to the new normality that we should expect, certainly for the next 3 to 5 years. It's not going to be a dynamic world in the housing market. Similarly, house prices, they're falling very, very slowly, about 1 to 2% down this year probably, and we'll look at the regional variations in a minute. In real terms, obviously, they are falling much faster than that, because inflation is running at about 3% this year on the CPI basis. So that means house prices in real terms will have fallen 3 to 4% this year. Wages will have been up about 2.3%, something like that this year, 2%. So in relative to people's incomes, house prices are getting cheaper, and that obviously means that as affordability ratios improve, that can potentially in future stimulate the housing market again. But I don't see that happening right now. I think we're still a year or two away from that happening, and we still aren't going to be getting back to those 1.3 million levels. So house prices likely to stay flattish to slightly down, but there is considerable regional variation. And see, London stands out 5.5%. That's driven not only by the fact that the economy in London has obviously been relatively stronger than elsewhere in the country. The London population is forecast to grow, I think, by another 1 million or so people over the next 10 years. That's going to continue to drive the shortage of housing in London, and obviously housing, like everything else, responds to supply and demand pressures. So a short supply, a lot of demand pushes prices up. London is likely to remain relatively strong compared to the rest of the country, but it cannot outperform forever. If you look at the northeast, 3.2%, that's the worst. The northeast is one of the regions most dependent on public spending to keep employment going. I forget the figures now, but there are some very clear splits around the regions between the proportion of people who work for the state in these different parts of the country. The southeast is the lowest, the northeast is the highest. The public sector cuts haven't begun in a big way yet. When they do, there's clearly no reason to expect people in the northeast to be wanting to rush out and buy houses. Incomes will remain under pressure in those regions most dependent on public spending, and so you could expect the housing market to remain relatively weak in those regions too. And then all the others are different shades in between. It's not likely, it's not possible really that you could expect a divergence to continue indefinitely between all of these regions, but the trend has been now set for certainly the last 3 or 4 years and is likely to continue for a little while yet. But really, when you look at these numbers, it's sort of like arguing about angels dancing on the head of a pin, because the numbers are so low. All of them are pretty low. Even London's only short sort of level ahead of inflation. So arguing about a 1 or 2% differential between regions doesn't really get away from the fact that the housing market really isn't doing very much at all in price terms, and we don't really expect it to. So here's what it means for purchase approvals. Now, they peaked a little bit before gross lending did, because you may remember that remortgaging just became frenetically fashionable a little while after, just before the crisis began. And purchase approvals were running at about 1.4 million a year in 2006. 610,000 is what they are doing to date. So that's the rolling 12-month total to date. 40%, 45% of where we were at the peak. And we're seeing about £90 billion lent into the housing market in new money over the last year, compared to 200 billion at the peak. Again, that lack of supply of money flowing into the housing market means there is not much money pushing prices up. Okay, so that's the relationship between the purchase, the amount of mortgage lending for purchase and house prices. While that is low, you would not expect there to be an awful lot happening to house prices. The last piece of the lending puzzle, of course, is remortgages. And that peak held up a little bit longer at the end of the boom, and we had a peak of remortgage business almost the same size as the purchase market, £170 billion, and that was just churning money. You may remember everyone was on 2-year deals and everyone was fighting for remortgage business. That money was just churning over and over and over again. It was great for the mortgage broker industry, obviously lots of nice fees coming through from the lenders as they fought for market share, but it didn't actually have any real effect on the underlying housing market, because it's just sort of switching money from one pot to another. Now we're at £48 billion, so almost a quarter of the peak of remortgage lending. And many of the lenders are still trying to actively discourage and actively shoo borrowers away. Someone in my office got a letter yesterday from, and he's someone who's quite well paid actually, has a nice house, pretty good prospects, and yet he got a letter from his lender inviting him to take his business elsewhere, pretty much. So he'll be refinancing with somebody else as well. So that's all part of that attempt by many of the financial institutions to shrink their balance sheets, chase customers away that they don't want, to try and bring their capital ratios back under control. All of that's likely to keep this relatively subdued as well. Which takes us back to the macro picture. If there's little demand in the economy, there's not much activity in the housing market, which is one of the vital engines of the UK economy, not much consumption going on. What is the outlook for the overall economy? And this is the latest consensus set of forecasts, which is published by the Treasury, but it's all the economists, independent economists in the city and elsewhere who submit their figures. And as you can see, we're looking at growth next year about 1%, inflation broadly in line with target, unemployment flat, and borrowing continuing to rise. And they don't expect interest rates to go anywhere. Pretty much flatlining. And I'm afraid to say that's what I would expect the economy to be doing for the next 2 to 3 years. And that's it from me.
Any questions for Mark? Does anybody have any questions they want to ask? Because if not, I'll have to make one up. What should be? Sorry. So the question was, is there any chance of the restrictions that are being placed on lenders changing? Why lenders are not lending? Okay.
It's certainly an important reason why it's happening, and the industry is lobbying very hard to try and make the UK authorities see how difficult those conditions are making it for them to do business. Part of the problem is that when you look at the financial sector as a share of the UK economy, it is unusually large compared to other economies. Now, does that mean the UK economy is extremely unbalanced and heavily dependent on financial services? Not if you look at the UK in the European context. The UK is the financial centre of the European Union. So in that respect, our financial services industry doesn't look unusually large. But what it does do, unfortunately, is it means that we have more of those systemically important organisations based here in the UK. So I think that there is this uncomfortable doublethink going on in the UK authorities who simultaneously don't want ever to have to put public money up to support the banking sector again, but also understand the need for it to be the importance of the banking sector in growth in the economy. So there is a lot of lobbying going on. I suspect they probably will roll it back, but it's not going to happen yet. I think that there's still too much political capital to be made out of bashing the banks.
I think there's a second side to that, which is the fact that the government, there have been a number of initiatives in the last 6 months. They haven't seen how they've all flowed through yet, and therefore until they see how those flew through, they're not prepared to do anything else. The governor of the Bank of England has said they will be prepared to do more to try to keep the economy moving, and they see the mortgage and the construction sector as key parts of that. Therefore, we may see more, but I think it's also about them not wanting to do too much that then drives into a place which A, could be inflationary, and B, which surfaced again this morning, damage our potential credit rating, which is the other thing they can't afford to be impacted on.
Is that issue of the credit rating is one that comes up perennially. Moody's has said that if we go back into negative growth territory, they will be looking at downgrading the credit rating to AA from AAA, and that's obviously a politically important thing. Whether it really affects our funding costs is another matter. And as I say, I think minus 0.1% or plus 0.1% is neither here nor there. So I think Moody's is slightly holding fig leaves up over sensitive parts when it comes to talking about that.
Looking at the figures, I think you're covering something. Looking at the figures, the bank of interest, bank rate. What's your view on interest rates? Do you think they will go up, they will come down? Because from yesterday, because of the inflationary figures, some quarters were predicting that based on that, if it continues, then the chances are that something will have to give. What's your opinion on that?
I don't think you'll see base rates move for quite a while yet. The Bank of England has said, I think it was last week, they said they weren't planning to do any more quantitative easing for the time being. Let's have another look in the first quarter and see what they say. I suspect there may well be another 50 billion coming out from the Bank of England on the quantitative easing, and I'll come to the interest rate thing in a second. The other important thing that happened is the Chancellor did a bit of a raid on the Bank of England last week. It's quite funny. No one's really noticed this. But what he did was, because the Bank of England has bought all these bonds from the government, that means the government's paying a lot of interest to the Bank of England on those bonds. That's what's called the coupon. So the Bank of England has got an account with all the coupons in it. And George Osborne raided it and said, I'll have those, thank you very much, and taken them back again to help fund the deficit, which is effectively like throwing more quantitative easing at the economy. He's taken the interest he paid to the Bank of England back again to help fund the public sector. So all of that is what that means is that they're continuing to keep monetary policy really loose. I don't think they're worrying about inflation. They're not going to try and squeeze inflation out by tightening policy, because I think they think the economy is weak enough to do that by itself.
Any more questions? I'll ask one, because it's something we've talked about, and that is, I suppose, looking at this from the other side of the equation, is that bond yields at the moment are relatively low and have stayed low, but we have a vast amount of money invested in the UK in bonds, and at some stage that has to reverse. Is there a point where you think this will happen, and therefore what will that do to the capital values of everything that's sitting in, effectively, bonds at that point?
Well, the bond market undoubtedly is in the middle of a bubble at the moment. You just have to look at, if you see bonds only yielding 1.72%, 10 years, cash you can get, depending, if you want only short-term cash, you're on about 0.25%. If you're in a deposit account that you're prepared to lock it up for 3 years, you get a couple of percentage points. Equities, if you want income, that's the place to be right now. You can get on a gross basis, about 4.3% income from equities. The reason that bond markets the yields are as low as they are is because everyone's scared, and obviously some of those other factors I talked about. And there's an awful lot of money sitting in bonds. When that has to come out at some point. There's far too much money sitting in bonds. People are, when bond yields are low, that means there's a great demand for bonds. So there's a wall of money that has stacked up in the bond market. When that comes out, you will see yields, or the cost of borrowing, rise very sharply. I don't know when that's going to be, I have to say. Trying to call the end of a bubble is a very difficult game. You might remember .com has happened once or twice. You can make a lot of money while bubbles are inflating, as long as you get out 10% before everyone else does. I don't know when that's going to be, Robert.
Which then ties up the other part of that equation, which is the amount of money sitting in PLC balance sheets.
Yes.
Because that's the other part of the thing I know you've looked at from something else you're working on.
£754 billion of cash sitting in bank accounts of companies around the UK. £754 billion. Remember that the UK economy is 1.5 trillion, so that's half the amount of sort of activity in the economy, if you like, is just sitting in cash in company balance sheets. That's because companies are quite profitable right now. They're not investing very much, as I said. They've got relatively high levels of inflation, so they've got a bit of pricing power. They're putting their prices up. And that money then starts to accumulate in their bank accounts. They're too afraid to pay all of it out in dividends because they don't know what's going to happen in case there's another credit crunch. And so it sits there. Now, we've talked about this, Robert, whether the government's going to start having its eye on that cash and want to try and get its hands on it in some way. I would hope we're not going to end up in some kind of kleptocratic state where governments can just nab capital at the drop of a hat, but you never know. It's possible.
Okay, I'll call the end of that session here now. Can I ask you to say thank you to Mark in the usual way?
Thank you very much.